All right, today we're talking about a really bold, high-stakes corporate move. Imagine a huge real estate company deciding to just up and leave an entire country, selling every single thing they own there. Why on earth would they do that? Well, that's what we're digging into.
Yeah, that really is the central question, isn't it? It just sounds so drastic, packing your bags and liquidating every last asset. But here's the thing. This wasn't some kind of panic move. Nope, as we're about to see, this was a carefully calculated, strategic retreat.
So the company at the heart of all this is First REIT. They're a major player in Asia, specializing in healthcare properties. And the bombshell news is that they've proposed a complete and total pullout from Indonesia, selling off their entire portfolio in the country.
Okay, let's dive in and unpack this shock announcement and figure out what it really means.
First, a super quick refresher for anyone who needs it. A REIT, that's R-E-I-T, stands for Real Estate Investment Trust. Just think of it as a company that owns and runs properties that generate income. Like hospitals, offices, shopping malls. It's kind of like a mutual fund, but for real estate instead of stocks.
Now, this decision did not happen overnight. Not even close. You can see the process actually kicked off way back in January 2025. It all started with an offer from a long-term tenant, PT Salam. That single offer was the domino that set off a full-scale strategic review, which finally, a year later, led to this huge decision to sell it all.
Which brings us right to the core of the issue, the big why. What was going on that was so bad they had to make such a drastic move? Well, let's unpack the main culprit here, the sinking Indonesian rupiah.
And this is the absolute key to understanding the whole story. It wasn't because their hospitals were failing. In fact, if you looked at their revenue in the local currency, the rupiah, things were going just fine. The problem, the massive problem, was that the value of that money was just collapsing when they converted it back home to Singapore dollars. This chart just says it all, doesn't it? Over 5 years, the rupiah lost almost 28% of its value against the Singapore dollar. Think about it like this. Imagine you get a big raise at your job, but every time you get your paycheck, it's worth less and less. That's exactly the nightmare First REIT was living with its Indonesian earnings. And here's where it started to hit the investors directly. Those distributions per unit, which are basically the dividends you get for owning a piece of the REIT, they fell by 17% in just 4 years. The income was quite literally getting lost in translation.
Oh, but it gets worse, a lot worse. The net asset value, that's the fundamental worth of the actual properties, it eroded by a staggering 32%. So not only were the yearly paychecks shrinking, but the core value of the investment itself was just evaporating on paper.
And all this created a dangerous third problem. Gearing, which is just a fancy term for a company's debt level, shot up to its highest point in 5 years. Why? Well, it's simple. As the value of your assets plummets, your debt starts to look a whole lot bigger in comparison, and that means a whole lot more financial risk. On top of all that, they had other storm clouds gathering. Their Indonesian properties were getting old, averaging over 20 years, which means they were staring down the barrel of some huge investment costs. Plus, their few remaining leases that were paid in stable Singapore dollars were about to end, meaning they were about to be even more exposed to the volatile rupiah. You can see how the walls were just closing in.
Okay, so the problem was crystal clear and it was getting worse. So what was the answer? Let's deconstruct the impressive, nearly $500 million deal they put together to fix everything.
And there it is, 471.5 million Singapore dollars. That is a huge number. This was a single, massive transaction designed to solve all of those problems in one clean, strategic move. The deal itself was actually pretty clever and had 3 main parts. First, they sold 8 of their main hospital properties to their tenant, Siloam. Second, they offloaded 3 other properties, things that weren't hospitals, like malls and a hotel. And third, and this is the really smart part, they secured what's called a put option. This gives them the right to sell their last 6 hospitals to Siloam later this year, but not the obligation. It's like having a guaranteed buyer in your back pocket, just in case you need them. And this table here gives us a nice clean summary. You can see PT Siloam was the big buyer, taking the hospitals off their hands. A couple of other groups picked up the non-core stuff, and it all adds up to that grand total of just over $471 million.
So, the assets are sold. The cash is in the bank. What's the big plan now? Because this move wasn't just about escaping a bad situation. It was all about pivoting to a new, much more stable strategy for the future.
The strategic benefits here are crystal clear. The biggest win? Poof! The currency risk that was slowly bleeding them dry is completely gone. They can also use all that cash to pay down debt, which makes their financials so much stronger. And maybe most importantly, they can now refocus all of their energy and capital on growing in safer, more developed markets.
And you don't just have to take my word for it. This quote from the company itself says it all. This was their chance to fully exit a volatile market, streamline everything, and refocus on what they see as a much brighter future in developed countries.
And finally, let's talk about the bottom line. After all this strategic maneuvering, what does it actually mean for the unit holders, the folks who actually own the company? What's the payoff for them?
Well, the first payoff is pretty immediate. As part of this whole deal, they're getting back nearly $7 million in unpaid rent that was owed to them. So that's a direct cash injection right back into the company's pocket.
And here is the most direct reward. First REIT is also paying out a $9.7 million special distribution directly to its investors. Think of it as a cash bonus, a way to share the profits from the deal and thank them for their patience through all of this.
Now, looking forward, the yearly dividend will actually be a little bit lower. But this is the key trade-off they're making. They're intentionally swapping a slightly higher but wildly unpredictable payout for one that is stable and reliable. The goal here isn't just about the size of the check. It's about giving investors predictability in a very volatile world.
Which leaves us with a pretty interesting thought to end on. You know, we always celebrate companies for aggressive expansion and constant growth. But maybe, in a world filled with currency swings and geopolitical risk, the smartest and maybe even the boldest move a company can make is knowing precisely when it's time to retreat.